to the channel. Today we're going to share about how to use a tool that StockPenguins.com has on its website. So that tool is the stock screener tool. So if you hop on the StockPenguins.com, we have a stock screener that's free for everyone to use, right? Where you can filter out any, companies, attributes, characteristics, valuation, industry, things like that, and then we'll churn out a list of stocks for you to deep dive further into. So before we dive deeper into this, let me share about tips on what the stock screener is, how you can use it, and how to avoid any common pitfalls when using a stock screener. So a stock screener is basically a tool that filters out the universe of tradable stocks by financial, market, and technical criteria. So think of your market cap, your valuation metrics like PE ratio, growth rates like revenue growth, bottom line growth, dividend yield, sector, etc. So basically what it is, right, and what it aims to serve is that it is a discovery tool, right? So it reduces the thousands of tickers out there to a manageable list of stocks, right, that matches your strategy, your risk management strategy, your risk appetite, right, your criteria. But ultimately, at the end of the day, it's a tool that doesn't aim to replace research, right? Your due diligence must still be done, right? So this is just a tool that helps you kickstart and find a list of stocks for you to narrow down your research into, right? So how do you start using a stock screener? So number one is to know your objectives deep down and know what your investment style is. So you need to know your risk appetite very well, how much cash you have set aside to grow your grow your investment, and also how much what your age, how much runway you have, is this your only income dependent source, and things like that, right? So all of this will ultimately boil down to what you are looking for. So there is a certain niche of companies, groups of companies that you can invest into. So number one, your value bargains, right? Whether you're looking for cheap price versus the fundamentals that is showing. Growth leaders, right? So this is more for the aggressive investors that doesn't mind volatility in their portfolio, right? So fast revenue and earnings growth. Dividend income, so maybe you want more stability, right? You want to slowly grow your wealth over time. You prefer to see cash flow coming in. Then you look into dividend income portfolio, right? Where you look at stable yield plus manageable growth, right? Number 4, momentum trend trades, right? So all these are more technical in nature, which our site don't really provide this data as of yet, right? But it looks into relative strength, 52-week price performance, things like that. Your RSI, technical indicators, whether it's showing high or low, and then opportunities are there. Small caps, right? Multi-baggers. So usually this would mean that it would show how much room there is for the company to grow. So for example, a Google, right, at about over 1 trillion market cap, the possibility and timing for it needed to double its valuation would take a lot more years compared to a company that say 1 billion in market cap. Going to 1 billion to 2 billion is very possible and very fast as well. But this also means that there is more volatility that the investor must stomach, right? So these are the things that you have to consider. And besides just knowing the styles, the investment style, and what kind of companies you're looking for, you must know the components that contribute into the stock screener by heart, right? You need to know exactly what each of these criteria, the definitions are, and how it will contribute to a company's fundamentals and any criteria you're looking at. So for example, valuation, your price to earnings, price to sale, PEG ratio, it usually signifies over or under valuation, but you need to know what contributes to the PE, why is it high, why is it low, things like that, right? And you also need to know the sector that you're looking to invest into, right? So why? Because there are sectors go through market cycles as well. So you need to know what stage they are at. Is it a sunset industry, right? Is it a fast growing industry like AI, right, where there's a lot of tailwinds boosting the industry? So usually when the tide rises, right, you'll bring a lot of companies up with it. Or you're investing in the oil and gas industry, where it's on sunset industry, right, where basically you wouldn't see much growth, you might see some stability, but that's about it. Yep. So you need to know all these kind of contribution factors very well. Market cap, like I mentioned earlier, right, it may give you opportunity to find multi-baggers or something that's more stable and less risky, right? So the probability of Google doubling its valuation is a lot more higher compared to, say, a small cap stock doubling, right? Even though the time duration it might take may be a lot longer, right? And ultimately, So let's take a look at how we could use it, right? So we already set aside some filters that you can save, right, onto our Stock Penguins stock screener tool, right? So I have set aside a fast growing, profitable filter list, right? So looking at mid cap companies, right? Decent, strong gross margins over 70%, and yep, when you search for the high operating margin, right? Revenue growth above 10% on a average 5-year basis, right? So if you search for this, right, this is a list of companies that's filtered out, right? And then you could, sort it by market cap, right? Your PE ratio, dividend yield, things like that, and find a company that you could dive further into. So that's basically how you use a stock screener. Another example will be looking into medical devices that are profitable, right? So same thing, industry, medical devices, right? Profitable, positive net profit margin. And then these are the stocks that churn out. But you could always play around with it, right? By changing the market cap. You want to say small cap. And then, the list will change accordingly. And this is where you can begin your deep dive and due diligence work, right? So now moving on to the common pitfalls and how to avoid them when using a stock screener, right? Is to avoid thinking that a screen equals a recommendation, right? So screen are filters. So besides that, you shouldn't just, like I mentioned, buy and sell based on this outputted list, right? You should always, conduct fundamental and qualitative check, right? So you should deep dive into, say, this company's financials, right? Deep dive into the financials, and look at what the valuation metrics are, any other liquidity ratio, things like that, operational ratios, debt ratios, and then look into its earnings call to see what the management has been talking about, what they're addressing, anything they're optimistic about that could drive growth in the future, things like that, right? Besides that, you should also conduct a quick industry deep dive, right, to understand what exactly the company does, what the industry, any tailwinds or headwinds in the industry that could lift the tide or just bring every company down, right? So these are the tools that could help you. Stock screener is meant to help you kickstart your research, right? And survivorship bias and look ahead bias in tests. So this is more for your trading related data, your technical one. But I think it could also spill over to fundamental research, especially if you tie with this next factor, which is data lag or stale fundamentals, right? So free screeners sometimes use delayed data. So this might be the case, right? Because companies only report their earnings once every quarter, and all of this screening criteria is largely based on their quarterly reports provided on their financial statements. So you should always look into the news, right? Look into whatever's happening with the company. So any narratives that's happening with them. Are they facing any issues? Are they facing any potential catalysts that could drive the stock price forward? For example, a partnership with an AI company, things like that could drive stock price forward, right? Number 3, which is do not blindly trust single metrics, like for example PE alone, right? So you must always combine your valuation with growth, margins, cash flow, and balance sheet, etc. Because like I mentioned in many of my videos back in 2021, 2022, right, there was a lot of growth companies that their share prices rise up crazily and then they came back down to earth correspondingly as well. So because a lot of these growths are not sustainable, right? So you should always combine your growth with your margins, your cash flow, and balance sheet health, besides just using valuations, right? And my next tip, right, practical tips. So you should always layer your matrix together, right? So for example, if you want to look for low PE companies, right, you should always combine that certain criteria with improving revenue growth, positive cash flow. It's a better signal than any single metric alone, right? And next, you should always use relative industry filters, right, rather than absolute thresholds. So for example, you cannot filter out tech and you cannot really compare a tech company to a utilities company if you didn't really single the industry out in the stock screener criteria, because the fundamental attributes or characteristics of a, say, oil and gas company is very, very different from a tech growth company, right? One big example is the gross margins, right? You wouldn't see any company in the oil and gas industry with gross margins above 80%, which is still a quite common thing in the tech industry, right? So you should always compare apple to apple, compare relative industry filters rather than on an absolute basis. At the same time, like I mentioned earlier, is always monitor revisions or any news that's happening to the business, right? Always keep up with the company, and don't you just use this screener and then that's it, and then just leave your research at maybe even just looking at the fundamentals. You should also look into what's happening in the company. So one tool that I could use, right, is a news filter. You can just basically just search for example, AMD, right? Search AMD, and you can see what's happening with the company over the past, just recently as well, right? Always take that into account. And exactly, besides all this research, right, as you come up with a list of companies that you're investing into, you wanted to deep dive further into, and that pass your criteria, always keep them in the stock watch list and keep up with their developments, right? So they'll just leave it at that. Maybe they could pass the criteria at one point, but the valuations don't really match your buying price right as of now. So always keep them in a watch list, right? StockPenguins has a watch list tool for you to save your research. Yep. Lastly, diversify screens. Run multiple screens, right? You can always play around with your matrix, right? Yep. So sometimes when you churn something out, the list may not be that big for you to look further into. So you can always adjust your metrics accordingly. Don't just fixate on a certain criteria. Learn to be adjustable depending on the market narrative and dynamic, right? So at the end of the day, my bottom line is use a screener to narrow down the universe into a focused watch list that matches your goal, right? Always follow the screen with qualitative research, sanity checks, and and also screens are powerful time savers, but only the first step in the disciplined investment process. So that's all for today. Let us know what you want to see next.